Welcome to week 5 of Finance 1031. We've got kind of a grab bag of things to go through today, so I'll just start. So first of all, the midterms coming up in week 7. It's going to be entirely online on Vanch Online quizzes section, up to and including everything on the week end of week 6. And I'm thinking Sunday night I'll send out an email just to see if we can confirm that. I prefer to have everybody do it all at once. Keeps life simple. If you can sit down with your computer for say an hour and a half. The exam itself is only an hour long. If you can sit down for an hour and a half without being disturbed, that's probably the best thing. Okay, right about now in the course, I have to clear up something about taxes. Um, in the course, when we're talking about taxes, we're talking about income tax. We're not talking about GST, PSD, HST, anything like that. Um, those are called flow-through taxes. Um, so what that means is we pay them to our suppliers and then we collect more taxes from our customers. So what happens is we pay the difference to the government. We pay some HST out, for instance, when we buy lumber. Then when we sell the chairs that we make out of the lumber, uh, uh, hopefully at a higher price, then we collect more HST than we paid out. We pay the difference to the government. We don't really track those on a simple cash flow calculation. We might track it in a startup situation where the outlay can be significant, but typically we don't track them on a day-to-day basis or a month-to-month basis because we're not entitled to spend them. Okay, these taxes are collected in trust, and really they belong to whichever government we pay them to. So, just a note on that. Okay, now it's time for our weekly roundup of ratios. Uh, First, 7 we've got there, current, quick, gross margin, net margin, debt to equity, return on equity, return on assets, and of course ROI, which relates to both of them. Those are ones you should memorize. And again, not just for the course, but for your business career. We've also got interest coverage and fixed charges coverage, which bankers like. So onward. Okay, I'm hitting on these two again. I can't emphasize enough the difference between the two, return on equity, the overall return that the shareholders get on their investment, and return on assets, their overall return that the company gets on its investments. Okay. One, of course, is financing activity, and one is investing activity if we're thinking in terms of the cash flow statement. Recall that investors want to get a return on their investment, so if we talk about shareholders, they get dividends, and they also get the increased value of the shares. Okay, so increased value of the shares is pretty easy for publicly traded companies because we see their share price almost every second on the stock exchange. A little bit difficult, a little more difficult for Canadian privately controlled corporations. We don't have an open market for that sort of thing. Usually what we just do is take the book value of the company, which is assets minus liabilities, which is also known as the shareholder's equity, okay, or the owner's equity, and that is pretty much a quickie valuation. So that would be the value of all the shares that are out there. That's kind of intuitive, but sometimes still needs explaining. And that gives us our increased value for the shareholders. We often see small companies, unless they're going at some sort of a big discount might sit around for 6 months to a year before they're actually sold, or sometimes even longer, 2 or 3 years, just because they're not that easy to sell. When it comes to responsibilities for debt, depending which province you're in, directors of the company might be personally responsible for any HST collected by the company that's not paid, or Canadian Pension Plan payroll deductions, employment insurance, that sort of thing from payrolls, if the company goes out of business. Because one of the things that happens is if a company goes out of business, the money that is in it for payroll deduction, that sort of thing, is technically belongs to the government and no one else. That's just the way it is. It's sacred, for lack of a better word. And if in some provinces you can actually, if you're a director, be held personally responsible for that money. So be careful. If you're not involved in the day-to-day running of the company, you have to ask yourself, do you really want to be a director? Unless you've got daily access to the bank records and the payroll and that sort of thing. Okay, you should, and I can't emphasize that enough, should, must have a shareholders agreement if there's more than one of you. It's an agreement that outlines everybody's duties and responsibilities, and whether or not you can, for instance, use your shares as a collateral for loans. Or if you want to sell your shares, often it'll say that you have to offer them for sale to somebody in the company first. Okay. As a general shareholder, and if the company goes for a bank loan, you personally are not responsible for the corporate debt unless you actually sign the agreement. Okay. So just keep that in mind. Usually it'd be the president and or the treasurer or something like that, who are working in the company and have shares, who would be personally responsible for the debt of the company, i.e. bank loan. Okay, so that's it for lecture 1.